Okay, very good morning to everyone. Hope you've had a good evening. Quick overview of what we're going to cover in the briefing today. I'm going to go over a couple of the fundamentals, so go through the kind of main headline news stories, reflect that as to some movement we've had on the charts, and then I'm going to hand over to Sam, you can see in the background, and he's going to talk you through a couple of setups for the day ahead and strategies going forward across the various assets. So that's the plan of action. Taking a look then at the charts this morning, and a couple of things to recap from yesterday, and then we'll get into the crux of the news flow from this morning. And one of the things is that we were here late yesterday evening, so I was still watching the charts at about 7 p.m. last night. And one of the things that we had was a bit of a run-up in both major currency pairs. So really I'm looking, if I just isolate the particular price action in question, then it's really this point. And as you can see, when both these major pairs, euro dollar and cable, are moving in the same direction, then obviously really it was focusing on the dollar and dollar movement at that particular point in time. And there was a couple of things that were ongoing. This was before the Fed's beige book came out, and the dollar was continuing to remain under a bit of pressure. And obviously the dollar has seen a degree of volatility in the forex market in the last week or two. Now, one of the things here, I'm just flicking back on the headline feed, there was a Republican representative who was commenting, saying is undecided on the spending bill continuing resolution, and obviously this is going to probably escalate in terms of market focus and net sensitivity and price reactions, particularly in the dollar and US assets, as we get closer towards Friday's deadline, which of course is in regards to a potential extension, probably of another 4 weeks to mid-February or so, of the version of a government shutdown, so extension, short-term gap of the debt ceiling. So we had a little bit of dollar weakness, and one thing that definitely was interesting, and Sam will look at the kind of how to approach it for today specifically, but looking at yesterday's price action in cable, we got very close, of course, to a influential level, and that is the 140 handle. Sam walked in this morning saying, "God save Theresa," a staunch Brexiteer through and through. And whether this is down to Theresa, I would say no, it's not. It's dollar weakness that really has helped cable remain supportive, and we've continued to edge up towards. If we look on a daily continuation, I'll just remove this fib study there. You know, we were looking at this, these key technical levels, and really it's because the market doesn't have a lot of a reference point technically, given the gravity of the size of the moves that were seen post the referendum, and particularly the night of the referendum itself, obviously the biggest one-day move that we've seen. And after breaking that 38-35 level, we got all the way up to the 140 mark. And so really it was unsurprising, I think, when we've got to this kind of 39 price point, to get up to have a look and a test close to it. But it remains in play at the moment, and that 140 handle is going to be big, not just technically but psychologically, because if we start to breach that, then you would say it opens up, at least technically, still of course monitoring Brexit updates, but then it could open up further moves to the upside, particularly amid what has been more or less the last couple of weeks a persistent dollar weakness pattern. If that does continue, then obviously that will help fuel that move. But of course we need to look at the ongoing Brexit debates. That's kind of a bit quiet at the moment, and that's because the big trade EU summit with Brussels, and the real pivot point, if you like, for Brexit talks going forward in order to secure this much needed transition deal, happens on March 22nd, 23rd. So what I'd be expecting is that from a Brexit point of view, it's kind of all calm for the moment. But that's certainly going to rear its head come end of Feb, going into March, because then, in terms of trying to safeguard confidence that a deal can be done from the Conservative government and so forth, is going to be critical for then large multinational companies, calendar-wise, then getting to a point that if they don't have clarity at end of March, then they're going to start relocating, or at least that's what the threat has been. So it's calm on that point for the moment, but I'd say that then looking at the cable price action, granted if the dollar continues in the way that it has done, which is general weakness, then certainly, yeah, I think you can break 140 and go higher, but then I'd be expecting then the kind of speed of that rise to start to dissipate as we get closer to that March meeting, would be my kind of view. The other things that we've seen, there has been a couple of comments out of a Monetary Policy Committee member. Michael Saunders reiterated his slightly hawkish stance in saying that labour market tightness and signs of higher growth, I consider it likely that interest rates will need to rise further over time. Now don't forget that he and Ian McCafferty are one of the more... Sorry, one moment guys. Sorry about that. So, yeah, one of the major points that I was saying was that Michael Saunders and Ian McCafferty were two of the most hawkish people that we've had from the Bank of England for some period of time. So these comments are unsurprising, but certainly the hawkish rhetoric has continued for the time being, at least. On the Brexit side of things, you might have caught a tweet from EU's Tusk. I think it was yesterday, and it was quite funny because he was basically saying that we still love you, the UK. If you want to come back, although you've broke my heart, then I'll welcome you back with open arms. That was a general sentiment. Lovely touch from Tusk. But it's been followed up. The head of the EU executive arm noted yesterday that the UK can always reapply for EU membership after departing. So Europe definitely are dangling a bit of an olive branch, trying to kind of further cement this kind of sentiment that definitely seems to have made some traction about potentially another referendum, this call for the kind of is this the right decision to make from some of the more Remainer politicians. Certainly it looks like they're trying to encapsulate on some of that emerging sentiment. On the flip side though, conversely, Theresa May, spokesperson, remains resolute. We have made absolutely clear we are leaving the EU. I'm not sure how much clearer we can be. So that still remains at that point the government view. But yeah, I'll leave Sam to have a look a little bit more intraday. I would say though that personally my preference would be, again, finding spots to want to get long at this point. I think a retest of 140 seems logical going forward. Looking predominantly on the back of dollar weakness, but also a lot of that dollar weakness fueled by really euro strength. Now that's the other real big story that's going on at the moment. Although the euro-dollar pair has weakened slightly, if you start looking at it on a slightly longer dated time frame, so if we go to 120 here, the euro-dollar pair is still highly elevated. Coming into 2018, you can see we were trading a sub of 120 only about a week or so ago. And now we're up here getting close to 124 test. And then essentially what happens when euro dollar gets to these levels? Well, this is when you get the uptick, if you like, in commentary from the ECB trying to verbally manage the currency. And so to give you a bit of a flavour for what we've had, ECB's Novotny noting recent strength is not helping and must be observed. Further, ECB's Constancio noted, I'm concerned about sudden movements in the exchange rate, which does not reflect changes in fundamentals. And then they roll out the carpet for the most traditionally hawkish member of the Bundesbank, Jens Weidmann, who spoke this morning and said that marked reduction in German growth potentially could translate into lower long-term interest rates. So even the most hawkish member is looking to talk down the euro a little bit, and I do think that this does change then the shape of discussion for how Draghi is going to sound in upcoming press conferences, where I think that he'll be very mindful of trying to manage the fact that the market has been very bullish, its outlook for euro going forward since we've come back for this year in 2018, and he'll know that, and he'll want to mitigate that irrespective of the fact that the ECB might even be having these discussions about further unwinding of their policy going forward. So that's the euro story. A couple of other things from overnight, then I'll hand you over to Sam, so I'll quickly run through a couple of the headlines to be aware of. China GDP follows a series of economic data that's come out from overnight. In summary, Chinese GDP was a slight beat on expectations by only 0.1, but does mark the fastest pace of growth in 2 years. Retail sales in China was down, lower than expected. Fixed asset investment, industrial production was slightly higher. So a little bit mixed, nothing particularly groundbreaking here, and as such, you haven't really had any real sustained reaction in the Aussie currency. If you're looking at the Aussie, then really it's the jobs data that typically tends to see the most volatility, and this was what happened last night. So Australia's jobs growth keeps surging. So participation rate jumps to its highest in almost 7 years. The economy added twice as many roles as predicted in December. A couple of things here. So this is the details. Data from Australia showed the economy added twice as many roles as forecast in December. It's the 15th straight month though of job creation. So this isn't actually a new occurrence. This has been a persistent pattern that we've been seeing. The currency was little moved after initially whipsawing, while the creation of 400,000 jobs last year has done little for the government's political fortunes. The reason the so-called jobs bonanza isn't translating into wage growth. This is definitely a global situation here. It's not just the UK, it's not just America. This certainly is a prevalent theme across these major developed economies, where we're not in an employment crisis, we're in a crisis of people aren't getting paid more, and so there's a disparity of which the cost of living is kind of out of kilter at this particular point, and particularly is worrying given the fact that inflation is set to be a key feature of 2018 and likely to be on the upside, whereas wages remain relatively stagnant. So this is going to further fuel that divergence in that sense. Other things that we've had, let me just refresh my page and I'll quickly flick you over to the oil chart so we can see what happened last night. So going to 9:30, we've had a slight uptick here in WTI crude, but if anything it has already been reversed and we're sitting at pivot. My web page is not updating, so let me just run you through verbally what the numbers was last night. We had a drawdown in the headline API crude oil inventory of 5.121 million. This was a slightly deeper draw than expected of 3.15. Cushing was a draw of just shy of 4 million. Expectations were for a build of 2.5, so actually that's a real big surprise on the Cushing number. Gasoline was a build of 1.78 million, distillate a build of just over 600,000. This is the 9th straight week of crude draws and gasoline builds. So again, that divergence between those two specific measures is not new. But as I said, a slightly larger drawdown in crude and Cushing, so we initially moved higher, but we have retraced that already this morning, so there has not been a sustained move. Just as a reminder on the calendar, as always, given the US market holiday on Monday, it means that the DOE numbers this afternoon will be at 4 p.m, not 3:30, as would be typically the case. Talking of oil though, this is a headline you should be aware of, because it's not only talking about the crude stock situation. What we're talking about here is rebels in Nigeria have threatened to attack the country's petroleum infrastructure. Now certainly tensions on the Niger Delta and their kind of heavy reliance on the pipeline structure in the southern part of the country is absolutely influential for the productivity of the country. They had managed, having been exempt along with Libya, to really ramp up production since the OPEC initial agreement came in the beginning of last year, but it seems apparent now that they're running into further issues of the Nigerian militant groups in the Delta Avengers threatening to launch attacks on the country's oil sector in the next few days. So certainly I'd say these are types of headlines in that specific region that you should keep half an ear out for if you're monitoring the news wires. One of the other things I just quickly wanted to show you, and really this is a lot more broader, bigger picture in a sense, and I just saw a really interesting graphic about US debt sale projections due to rise. So this is talking about the expected issuance of US fixed income debt. And as you can see, it's quite frightening the levels of which the US is adding further debt in order to basically fund President Trump's tax package, and amount of debt that the Federal Reserve plans to redeem at maturity this year is going to bloat the issuance this year alone to about $1 trillion in 2018. Don't forget, we're currently already at an incredibly swollen balance sheet, if you like, on a Federal Reserve perspective, tracking up at around $4.5 trillion, comparative to 800 billion pre the inception of QE a decade ago or so. So to put this in context, that means then that overall, in terms of the Fed, it's going to be, and the amount of Treasury issuance, that's up more than 50% from a year earlier. And when coupled with the 30% rise in the amount of corporate debt that's due to mature, obviously this starts to leave questions then, who's going to be the buyer of all this debt coming to market? Now, I'm going to draw this into something else that I was reading this morning. I'm not sure if I've still got the web page up. Looks like I haven't. But one of the things here, okay, this is the story I'm referring to. And just so happens that overnight, China's holdings of treasuries have slumped now to the lowest level since July. Now, this starts to then make a bit of sense about the political jousting that's going on here. If you remember, one of the biggest stories that moved the market last Tuesday was a Bloomberg scoop suggesting that China was contemplating severely winding down their size of purchases. Now, this is obviously highly influential because China is the biggest holder and buyer of US debt. Now, what's happened is holdings of Japan have also dropped, hitting a 4-year low, while China's treasuries holdings have slumped to their lowest level since last summer. So these two countries, China and Japan alone, account for 1/3 of all foreign held treasuries in the world. And then what we're saying is the US, under Trump, are due to go to market with an extraordinary amount of supply going forward in order to fund the administration's plans. So the questions are, you've got a little bit of leverage here if you're China in this whole kind of trade battle ongoing at the moment, in that really the US is dependent on China buying it, and obviously they can use this then as I say, a bit of leverage where, okay, you've got all this debt, we're the people who've got the money to buy it, so you start playing ball with us and we'll play ball with you, so to speak. So hopefully it starts to make a bit of context around why there is these types of the political influence, if you like, into the economic situation in that sense. And finally, this is one thing that I've seen this morning, and Apple, the company, are going to open a new campus as part of a 5-year, $30 billion US investment plan, and will make about $38 billion in one-time tax payments on its overseas cash, one of the largest corporate spending plans announced since the passage of the tax plan by Trump. So this obviously, when Trump wakes up this morning, you're going to hear about this. He's going to tweet it. He's going to big it up, make it sound like this is exactly what he wanted. Apple, I've seen this morning, are dishing out a free $2,500 to every employee that they have, similar vein to what we've seen with Walmart and other companies in recent weeks, given the tax plan. So certainly this is going to play politically into Trump's narrative, if you like, of making America great, giving money back into the hands of American people and so on. Now, the reason why this I thought was quite interesting was Apple are putting $38 billion in one-time tax payments into overseas cash. They're repatriating it back into the US. So that sounds like a phenomenally large amount of money, and it is. But I just wanted to recap here this slide that I think I've shown to you guys before. Now, this is actually slightly dated, so actually the number's even higher. But this is just a infographic to show you S&P 500 companies with the highest share of cash held overseas, and lo and behold, Apple holds the number 5 spot. 93.3% is held overseas. And so, as per the plan, obviously the corporation tax is being slashed to 21%, but this one-time off repatriation of foreign profits, that's even lower, don't forget. So to give you an idea, they're repatriating 38 billion. They have got, you're talking nearly 300 billion sitting offshore. So there's plenty more there. This is kind of a more token amount, even though we're talking phenomenally large numbers in that sense. All right, I'm going to hand you over to Sam. I'll let him look at the charts briefly and then wrap you up with the calendar, but I'm going to wish you a good day. Any questions, of course, you can reach me in the chat room. Okay, guys, thanks.
Morning, guys. Hope everyone is doing well. We'll start off having a look through. Lost this chart. Looking through the currencies. Let me just open this up here, and I think a good place to start is with the pound following yesterday's up and down move there, almost touching that 140. We did put a poll out on Instagram, or it might have been on the Facebook page, asking if we could get 140 this month, and we didn't quite get there, but the majority of people actually did believe we could. So we've still got a fair few trading days left to see if we can get there. Just lowering the time frame down, the hurdle at the moment today, is this area around the pivot, and as Jimmy said in the chat, is offering a decent area for the sellers to come in. But I'd be interested to see now on the sort of the lower time frames if we can start getting squeezed above there. But it's very much a case of buying the when the buyers are involved. Yeah, I think we're in there. It's done. And so if we can push above that pivot area, the buyers will be sort of in charge. I'd like to see, from a personal point of view, a proper push, up towards that sort of 139 on the futures, and then come back to find support on that level before then pushing on. And it is a fair distance away to get to even the R1 or yesterday's high today, but there still could be some room for that. Looking to perhaps buy lower down, you've got what has been a solid area of support, but yet again it's a case of judging it when the time gets there. You can see here it's held quite well, so definitely one to keep an eye on. Aussie dollar, we did have the data out overnight, sort of that knee-jerk reaction higher. You can see making the new high, but the unemployment rate, which ticked down, sort of having that negative effect, and we're pretty much not too far away from where we were trading before that release early in the morning. This is a good example though, and I think this is probably, and I was definitely guilty of it when I was sort of beginning my trading sort of journey, if you like. It was sort of trying to identify a level when it's been sort of tested too many times, and it's best to leave alone. So you can see the pivot here, when we just broke above at just after 8 o'clock, it would definitely have attracted a few people to get in and want to buy at this point. But this would be the time when I just look back at the pivot today, and you've already seen it cut through late last night, obviously the data, and beforehand cutting, breaking through here, then earlier on goes through, comes back. So it's almost a case now just ignoring that pivot. That pivot for me now is maybe an area you would look to take profit, but definitely not somewhere I would look to be getting in from an entry point of view. Similar to this level here was a good sort of resistance point in the market where people look to get into sell, but now since then you can see completely messed up, chopped up, best left alone. So just from this example here, the only places I'd even be half interested in as it stands would be these points where I'm just circling up now, where the buyers or sellers have really taken over at a period today. So the pivot for this market would just favour to completely leave alone. If we were to push higher, you obviously have the high of that data release, and then you can look a bit higher and maybe get the extension to the round number. But same with the DAX. Yesterday was a mess. Look at the pivot, absolute mess. And the similar thing is sort of happening now. If I just lower the time frame to 5 minutes and we can see what's happening around the pivot, I mean, why would you really want to get involved in that area? I wouldn't, unless obviously a headline was to come out. You can see a good area of support. Even if you were to go pivot, the target's so close. But if we were to get a push maybe below this point here, you can see it sort of opens the room and then opens the door down to a better risk reward trade. And I think that's the idea. Sell where the sellers are and buy where the buyers are. Obviously it sounds simple, but you want to sort of get in where the majority of the market are going to agree. And if previously for that day the pivot in this case has been chopped up so much. There's just so much indecision, and I would say best left alone. Have a quick look around at the other currency pairs. Euro dollar. I'm just going to put this on a 60-minute. You can see sort of got dragged around with the pound yesterday before coming back down in sort of similar fashion. I think the weaker dollar theme is still intact here. Although if we that is to the weekly range, it is ranging higher to lower. So it might take something quite big to get us out. But both for the pound and the euro, we're at levels not seen for quite a while. So understandably, you will get that sort of consolidation. Lowering the time frame down, potential entries as it stands for euro. I think the pivot looks quite a nice area. Even if you're looking for a short, it'd definitely be a nice point in the market where people would look to take profit. If you're only interested in the buy, you would only be interested if it goes above the pivot, for example, unless obviously there's a headline out, which has been quite frequent over the last couple of days with comments from the ECB. So that could be an opportunity, but I'd only really be interested in buying above the pivot from that sort of level there. Decent support areas made by the market, you can see here, and near the low of the day. Obviously, as the day goes on, new support levels will be created, charting patterns will occur, and you can get squeezes out. But as it stands, only really interested in those sort of points. As the DAX was briefly moving lower not too long ago, you did have US equities sort of following suit, and you can see here just on that low point. Imagine if we were, and we will do in a minute, to have a look at the down and the Nasdaq, it would be pretty similar. So definitely worth keeping an eye on here. But as active as here, good resistance last night before good support, but we are sort of getting squeezed in. Let's have a quick look over at the Dow. Yeah, relatively similar picture in the fact that we're coming back to a level of support earlier in the morning, and the Nasdaq, yeah, quite similar, albeit just lagging a bit behind the S&P. If we go back to the S&P, I think there every time the sort of cash open comes, it does really bring that sort of volatility. You can see following that on what day were we? Thursday, so Tuesday we had quite a decent sell-off. Yesterday afternoon, the 230 area came back down quite strongly to a level of support, and these lows, well, for all equity market, it wasn't exactly an easy opportunity to buy. It was really bubbling around there for quite some time before pushing higher. The pivot then acted as a strong resistance level. I think the opportunity to buy the dip is still definitely there and would be the favourable trade. For me, if it does come down lower, S&P, it could well be that this is the point you're interested in. Previous high from yesterday, good area support, pivot, new low of the day as target, for example, is an opportunity, or you get a break of that new all-time high we made late last night, and then push on from there. I think in this area now, in terms of if you're favouring the buy, it's going to be quite a tricky one to get involved in. Yeah, Jimmy just said sellers becoming more aggressive. There, they definitely are. It's weird to sort of say that with equities, because right near the all-time highs, but it really does feel when there's an opportunity to sell, it's going down a lot quicker than it is coming up. So just something to be aware of. Obviously, going into the end of the week, government shutdown talk still about, but I think overall favouring the upside. You take a very brave person to say this is the all-time high for the month or whatever, or the year. So I do favour the upside, but it might be that just waiting for it to calm down a bit and buy lower down is still the way to go, or really wait for a push higher. Having a look elsewhere, obviously we've got the data coming out for oil at a different time today, or 4 o'clock than that usual Wednesday 3:30. And similar kind of picture to the currencies, and the fact that it's sort of in this consolidation period after getting to levels not seen for a while. Let's have a look if we can get a bit of a trend line on here. You can see the recent lows are sort of getting squeezed in. Let's just see if this comes up at all. I mean, it's not too bad. It's not perfect, but you can sort of see here getting squeezed in. S1 doesn't look too bad. Lower or make the picture a bit bigger. You've also got a bit of support around there. Yeah, it's not too bad actually. Again, decent area of support, where the pivot is now. But it's a case of, I think, for a couple of these markets in that consolidation period, is sort of either being reactive and waiting for a technical break, or having your bias and only really getting involved when that bias that you have is matched. And it might be, for oil, you're only interested in buying, and you wait for the high of the day in R1 to go, and then you join in at that time. And it might be after the data, if there's a big drawdown or whatever, or it might be that you have a negative bias for oil. You don't believe it should be this high, a bit of profit taking, and you wait for this area we got on the futures 63.75 to come in. So a couple of opportunities, a couple of sort of interesting points in the markets, decision points. You can see that area in pound has come down quite strongly, and we're not now too far away from looking towards that low that we made as well. Any questions obviously on the charts, do feel free to put them in the chat, and I'll be, as usual, just posting some ideas of the markets that I am looking at. US equities still sort of drifting to their lower support areas. The DAX has found support on that pivot / just underneath, and I would really encourage you guys to almost leave that pivot alone, other than a target area for a trade. I think it is quite messed up. So yeah, any questions obviously do feel free to get them in. You've got FTSE on S1 on the cash on the spot market with yesterday's low, offers quite a good area of support. Then if pound was to keep coming down, would be a nice point to get in to the market there to see a drive higher. But I hope you all have a good day, and you get on better than Chelsea did last night.